You know, Nvidia is down 4% here in overnight trading. The S&P 500 is down 0.5%, little bit more than that, in fact, down 0.56%. And I'm just going to be honest with you, and this might not be the video for some people. I'm pissed off. This is the most corrupt market we've ever experienced in our lifetime. And yeah, I haven't been in the markets decades, but I've been in the markets since 2016, 2017, and I've never seen anything like this in at least from that time. Almost a decade now. Never seen anything like this. Because why? We got some breaking news for Nvidia, and you'll never guess what it is. Yeah, you probably would guess. It is Nvidia just got a subpoena regarding its antitrust investigation. But retail had no idea this was coming. You know who did? Everyone else. Big money, banks, they all knew. Nvidia stock was down 9% on the day, and Bloomberg decided to drop this bombshell story today, 24 minutes after markets closed. As the Nancy Pelosi stock trader account on X writes, with 751,000 followers, somebody had to know. Not just one somebody. Basically everyone. This was the largest wipeout of market cap value in a single day ever in the history of the markets. And everyone else knew about it and could position for it. Besides retail investors, we're the ones that got screwed. What's new? That's kind of how it goes. The only advantage retail investors truly have is to buy and hold stocks for the long term, because big money is too focused on short-term returns. When markets fall, they don't tend to buy at the right times, and as retail investors, we can take advantage of that. But what if I told you, yes, this market's corrupt, it's the worst I've seen ever before, but if I also told you that we can take advantage of this, at least if you are viewers of this video and viewers of this channel, you might say, how can we take advantage of that? It's something called read the tape and follow the money. Read the tape basically means read the markets. What are the markets telling you? What is doing well? What is not doing well? How are markets trading before data is released? Because I don't really care about Nvidia. I don't care about this antitrust suit for the broader markets. Let's be honest. Google has been in an antitrust lawsuit for like years, and there's still no resolution there. Nvidia, that would take years as well. Markets, they don't price things in years ahead of time. Google has been just fine. Every now and again, they get a headline about their antitrust lawsuit and the stock falls. And usually these antitrust subpoenas or lawsuits affect the stock for a day or two. It's something Wall Street gets over pretty quickly, because it's not going to do anything to affect Nvidia's near-term numbers for potentially years. I think there's a couple bigger issues happening under the surface. Keep in mind, part of the reason why I started to really question the data that we were getting and who is getting the data first, because remember the revision that came out 2 weeks ago to the non-farm payrolls? Well, in fact, banks and big money investors, they got that report when it was supposed to come out. But everyone else didn't. They didn't get that report for about a half an hour afterwards, because it was given to the big banks, leaked, if you will, to the big banks and big money investors, and not given out to essentially retail. Now, why is this happening? Why did big money get the news about Nvidia subpoena today before retail? The only logical conclusion there is systemic risk. Okay, the last thing you want during an election year, the last thing you want during, the start of the Fed's cutting cycle is to have a market maker or big investor, right? Big firm, Sequoia or Citadel or, Jane Street or State Street or some of these large investors to be in the wrong trade at the wrong time with the wrong amount of leverage and have the wrong news come out, right? You want to give them a heads up so they can position and make the best out of whatever bad situation we have. Okay, fine. They don't want systemic risk. That's the last thing you want at this point with, again, an election, the Fed's that's about to start cutting rates, and an economy that could be on the brink of a recession. The last thing you want's some hedge fund or, market maker blowing up. I get it. But this is just outright, I think, fraudulent at this point. And I'll take it a step further and say big money is probably getting all of the big data before we have it. So not just specifically to Nvidia, but the JOLTS job openings that come out tomorrow. I think it's no surprise that not just Nvidia and big tech sold off, but everything kind of sold off, because odds are good that you're going to have some bad JOLTS numbers tomorrow morning. And if markets continue to fall, it's going to mean odds are good that we're going to have a bad jobs report on Friday or bad ISM services data on Thursday. And I think that's the bigger issue for markets, because again, markets will get over Nvidia's antitrust lawsuit in no time at all. I think the economic data, this Friday's jobs report, that could be the bigger problem here. Now, I will also tell you that part of the reason Nvidia is selling off this, what is now including after hours here for Nvidia, or pre-market, overnight trading, whatever you want to call it, down about 3.5%. Overall, Nvidia is down like 12.5% in the last 24 hours. Part of it, and most of it, likely has to do with the economic data, the economy slowing down, and what that means for AI demand in 2025. For a lot of these companies, 4 of them supplying in about 50% of Nvidia's revenue, do they really need to continue to overspend on these AI chips, especially if the economy weakens and overall demand slows down for basically everything? Do they really need to keep overspending? Probably not. And let me just kind of give you this example here. Nvidia is going to have to do like $40+ billion of revenue for this quarter that they just reported in 2025. So Q2 2025, Nvidia is going to have to do some really, really, really impressive numbers. And I don't even think 40% would be that impressive. That would be, 25% year-over-year growth, somewhere around there. Is that impressive to justify Nvidia's, valuation? Maybe you could say that. But what are the odds that you continue to see that kind of demand for a whole nother year? I think when you're playing the odds or statistical probabilities game, they're not necessarily in Nvidia's favor, especially considering if the Fed does cut rates and let's say the economy avoids a recession or even goes into a recession for that matter. What companies are going to benefit more than Nvidia when the Fed cuts rates? Most of them, okay? Cyclicals, value, interest rate sensitive, dividend payers, they're all going to benefit in one way or another when the Fed cuts rates. Big tech, Nvidia, AI demand, does that really get boosted by the Fed cutting rates? If 50% of your revenue is coming from the top, 4 companies in our markets, and those top 4 companies in our markets have very little effects or very little of an effect when the Fed cuts or raises rates, like, is that really going to prompt them to spend more on AI or semiconductor investments? Probably not. So I think there is an issue here with the risk to reward with Nvidia over the next year. And now as we are in September, yes, seasonally a bad time for markets. I think the question Wall Street is asking is, does it make sense to be in Nvidia right now at these prices? And that's from my perspective. Now, part of this 12% decline could also be other internal problems we don't know about. You got to kind of read the tea leaves here, because I don't think this 12.5% decline is the antitrust lawsuit. Really, I think like a third of it could be the antitrust lawsuit. The other 2/3 is probably down to the economic data that we'll get this week, which, if I'm reading the tape here and what happened to markets today and what's happening in overnight trading right now, it does suggest that the economic data is probably going to come in pretty weak. And that's going to mean September's probably going to be pretty weak. And maybe more fears of a recession could start to come out. It's no surprise that companies that pay a higher dividend than the 10-year treasury did well today. 10-year treasury is sitting at about 3.8% or so. Any companies that are quality companies with dividends of 4+%, they outperform today. Most of them, at least. A lot of stocks, like even Dollar General, that has done very bad recently, they outperform today. Stocks that are trading at recession-like valuations or prices did well today. If I start to read the tea leaves here, start to read the tape is the official terminology of, read the markets. It doesn't paint the best picture. Now, I think tomorrow's JOLTS number, obviously, if it comes in lower than expected, that's going to be bad. It just simple kind of Econ 101. If you're looking to hire employees, you're probably far from looking to fire employees. So the more hiring you're looking to do, the better, right? At least from gauging the economy's perspective. So if we get a low number and job openings are collapsing, let's say tomorrow morning, well, we had a pretty good heads up of that based on the data based on how markets traded today. But I would expect markets are going to be pretty weak tomorrow on that as well. Now, Thursday, you will get the ISM Services PMI. I don't think that is as likely to be leaked because that is a private company that does this. So I would be more surprised if the ISM Services numbers were leaked ahead of time. You also have the ADP employment change, which again, that's another private data point that markets pay attention to. That also comes out Thursday in the morning. I would be surprised if that was leaked as well. They seem to be pretty respectable firms from what I can tell. Friday, you get the non-farm payrolls and the unemployment rate. And it's kind of like how Jerome Powell gets the data a day or two ahead of time. The major banks are getting the data a day or two ahead of time as well. So if they don't have this data now, they're likely going to get that data coming tomorrow or on Thursday at the latest, in my personal opinion. Someone's leaking out data, whether it's the government giving it out, whether it's someone leaking it out, big money's getting it. So the point is, if we are weak tomorrow and we have a bad JOLTS number, well, odds are the trading that we've seen today was just pricing that in. If tomorrow's weak, great. Then that means Thursday's data could come in weak as well. But really, if Thursday's weak, that's a surefire sign that Friday non-farm payrolls number is going to come in pretty bad. So I think you really want to read the markets here. And if the markets trade bad heading into Friday, you're probably going to get an even worse reaction on Friday. If that unemployment rate goes up at all, if the non-farm payrolls come in weak at all, Wall Street is going to rapidly have to force in a recession or at least partial recession risk. And that's going to be bad news for equities at these levels. So what I'm doing here is getting as much cash ready to buy the dip. I will only be buying the dip if the data comes in good. If we do dip before then and we're not building up those recession fears, or I will start to buy the dip once we're like 10% in correction territory. I'll start nibbling. 15%, I'll start buying more. 20% plus of a drop, I'll start really actively buying stocks, especially the stocks that are already trading at multi-year lows. If those suckers go lower, yeah, I think you're going to have some really good pickup opportunities. I want to stay away from big tech in its entirety. Big tech does not benefit enough from rates going lower. They've actually benefited more from rates going higher, which sounds crazy. But if you're a viewer of this channel, you understand exactly why. And honestly, I don't want to spend the next 10 minutes boring you with the actual reasons, the causes and effects to why the Fed raising rates has actually helped big tech. Hopefully, we all understand why big tech has benefited from the Fed keeping rates higher for longer and raising rates over the past couple of years. Long story short, they don't benefit from the Fed cutting rates. Small caps, value, dividends, cyclicals, all of those companies will, have a much bigger benefit from the Fed cutting rates. So those are the areas that I want to target. And I want good deals. I want stocks that are balanced in their pricing in of a recession, pricing in of a soft landing. I don't want to buy stocks that are pricing in this super rosy, optimistic outlook for 2025, when in all reality, at the best case scenario, we're going to get a bit of a mixed bag in 2025. It's not all going to be good. It's probably not all going to be bad. And there are certainly some stocks that are appropriately priced for the risk that we're going to face in 2025. But I do think right now, cash is king. If you are a trader and you want to hedge your portfolio heading into this Friday's non-farm payrolls report, I think that makes sense. As I have talked about before, if let's say the unemployment rate does exactly what it did last report, and for a while there, 1, 2, 3, 4 reports, we were just going up 1/10%, and then you jumped up 2/10 from 4.1 to 4.3%. If we jump up another 2 points, 2/10 to 4.5%, I think it's possible we could have a circuit breaker on Friday. I think the S&P could fall 7% and the markets could halt trading if that were to happen. Now, that's not my base case assumption. I think it's more logical. The unemployment rate would go up 1/10%, or as the markets are expecting, it could actually fall. That's why you really want to read the markets here, because if we do get some serious selling before Friday, then you're probably going to get a pretty bad jobs report. And the level of downside that we could see based on that is a lot, right? We're talking about 5 to 7% in a single day would be my expectation on that, because we bounce back so much, and we really are not pricing in any recession risk anywhere as far as the S&P or NASDAQ headline indexes are concerned. I think there's too much risk there to just be complacent right now and to not prepare for that potential outcome as well. Even though that's not a base case assumption, we're going to get more insight to what that could look like based on the next 2 days of trading. If stocks have another bad 2 days, odds are that jobs report's going to be bad, because someone's leaking out the data on the government level and on the company specific level. And I think it really has to come down to systemically important companies like Nvidia. That's a systemically important company right now to the markets. Like, they're leaking out the data to firms that need to have a heads up so they're not caught offsides, especially when everyone's been so bullish. There's some pretty shady stuff going on right now, but I think we can take advantage of it if we can recognize that this shady behavior is happening and start to pay attention to it, start to read the markets. And that's what I will do my best job at least I can possibly do here on this channel over the next couple of days, because that's where I think it makes the most sense to read the markets here with the kind of risk that we have heading into the first Fed cut. And it's no surprise, Tom Lee just went bearish today, and that was kind of one of the best heads up you can get to what's coming next in markets, in my personal opinion. Tom Lee knows people, and he was obviously told something that we probably don't even know about yet. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day and night. I will see you in the next one.